Hello, Sector Watchers. Welcome to this third episode of Sector Spotlight on Tuesday, the 15th of October. This is your weekly update on sector rotation and everything remotely connected to sectors, relative strength, and our rotational analysis. My name is Julius de Kempenaer, and I am your host for today's show. With me are Zach Dillon, who ensures that you'll be able to see and hear this, and Rachel Ackley, whose friendly voice you will hear when we go over some questions and any other issues. We're trying to make this an interactive show, and we encourage everybody to participate in discussions or ask questions, and I will try my best to manage and answer all your inputs through the various channels that are available. Email and social media are open 24/7. The live chat is open during the show, that means right now, and we will keep an eye on what's coming in and possibly answer as much as possible while we are on air. And here is the agenda for today. As usual, we will start with a quick overview of some asset class and sector performance. And then I have prepared a bit of research and some stuff on offensive versus defensive sectors, because a lot of people are talking about it, but how do you qualify? How does a sector qualify as offensive or defensive? There's a couple of ways of looking at it. We'll have a short break, then we'll come back with any questions that you will have. And I will go into a question that I actually received over email or suggestion, which has to do with a comparison or use of technicals versus fundamentals. So let's start with the overview of some sectors and asset classes. The good news is that you may have seen that your screen could have changed, the dashboard I'm talking about, because the sector summary is now available as a widget. And I have positioned it at the top right of my screen right here next to the market overview. And here we can really have a quick overview of what's going on in the markets. But as you know, I am always using RRGs, or like to use RRGs for my sector stuff and my asset class stuff. So let's get back to this screen there. I'll keep that on the right of my screen. There you go. And I'm going to bring up an RRG for asset classes first, because that's the big picture that we like to keep an eye on. We're not going to do the weekly. We're going to stick with the daily because we speak every week now. And here is what happened over the last 5 days with the various asset classes. And as you see, the fixed income stuff is still far on the right, but it is losing some momentum. It's rolling over. And equities are still furthest on the left. They are the weakest in terms of asset classes. They have gained some momentum, but they are still moving lower on the RS ratio scale, which still means that we have to be very, very careful what's going on there, especially because of the wide spread between equities on the one hand and fixed income on the other hand. If we do the same for sectors, and we switch to a daily chart here, then we see here the rotation over the last 5 days. And that is, I think, a little bit more positive. It's getting there, because last week we had all these, and we're going to talk about that later, defensive sectors in the top right, like utilities, real estate, staples. And they have come down. They have lost a lot of momentum. Utilities already went into the weakening quadrant. But staples and real estate are heading in there closely. And we have the little bit more aggressive, like industrials, materials, financials, inside lagging, but picking up, just like energy, but that's still far away. So the rotation seems to be shifting. And it's difficult, because here, if we bring this to the weekly, we get it more in perspective. We see that the big picture, or the weekly picture, still favors the defensive stuff, but it is rolling over. So the big question that we will be facing in the next couple of weeks is whether this rolling over here, what we see confirmed in the daily, will be a temporary setback of defenses and rolling back to leading, or is this a change for the better, and will the more offensive sectors starting to pick up? We will get into that later on. First, I've already used the words offensive and defensive. I caught myself saying them a few times already. And we use that basically all over the place. Now, if you go to the perf chart, that's a very popular chart page on StockCharts.com, and if you scroll all the way down to the bottom, there is the sector rotation model, and I think that is a model that most of us, at least myself, use if we speak about sector rotation and identify sectors as being offensive or defensive. And what you see here are the various asset classes overlaid on a market cycle, that is the orange line, and the economic cycle, and that is the blue line. And historical research has shown many times before that the market is leading the economy. So the orange line is leading the blue line. Now, if you know that, you can find those sectors that you would expect to outperform during various stages of the economic cycle, i.e. the market. So we plot the sectors over the economic cycle, and that's what you get then. So this is the traditional way. This is based on Sam Stovall's work, and I've worked with Sam on updating that model very recently. Sometime last year we did that. But I had a little bit of trouble with it because I kept running into observations that sort of didn't make sense. I couldn't actually place them. They were very difficult to see and very difficult to monitor. So I was thinking about how can we change that, and even better, how can we more quantify that? And then I just thought, you know what? We have a measure for how sensitive sectors or stocks are to the market, and that's called the beta. And here's my screen back. That's called beta, and beta is a measure of how sensitive a stock or a sector is versus the market movement. And I'm going to say it out loud. It's beta is the covariance of two securities, in this case, the sector versus the benchmark. So the covariance of a sector and a benchmark divided by the variance of the benchmark. So you're going to compare the volatility of the pair versus the volatility of the benchmark itself. And we can actually make that calculation in some Excel sheets. And I've prepared a little bit of that for you. There's nothing to be worried about. It'll become very clear later on. It's not all that difficult. What I've done is I've filled this spreadsheet with historical data. And actually, they are coming from StockCharts. And you can actually bring them up. If you bring up some stock, doesn't matter. So like XLK, and you change this to monthly. And then you go to past data, and change this to monthly, you will actually get all monthly prices for the whole history of that chart. I will not go over how I downloaded every data set and pasted that into this spreadsheet, but that's what I did. So these data are coming from StockCharts.com. We've got SPY at the start, and then we've got materials, communication, energy, etc., etc. Beta is calculated over a specific period of time. And I've started out with 12 months. So this is the 12-month beta, the 12-month sensitivity. And there is a formula here. I'm not sure if you're Excel buff, but what it actually does, it takes the last 12 months, because this is in reverse order, as you can see, October is here. So 12 returns, and you have to take the returns, because we're looking at standard deviations. We have to look at the returns. So the returns of SPY versus the returns of materials. That's what this does, that offset. And we divide that by the variance of the returns of the benchmark. And lo and behold, the result is in this cell here, which means that materials beta is 1.04. Which means this is a little bit more sensitive than the market. If the market goes up 1, you can expect materials to go up 1.04. Communication services is more or less in line with the market, but then you'll see, for example, energy, which is 1.43. So that's very sensitive. It's much more wide swings than the market as such. Financials 1.21, industry 1.26, etc., etc. Now watch this, because I said it was 12 months. Let's say that we want to have a little bit longer term angle. And I think like the presidential cycle, which is 4 years, so 48 months. And if I now hit enter, all these betas will change. So you'll see that that beta is a variable number. Sometimes people refer to it as moving beta, depending on the period that you use. So you can actually draw a graph of these betas. Anyway, that is how you do it. If you would like to have this spreadsheet, just drop me a note and I'll be happy to share it with you. And this is the second part of that spreadsheet. It's actually another tab, as you can see. And what I've done here is I have ranked these sectors, 12, and here is where some of the, well, maybe confusion or new observations are coming in. Because who would have thought that energy would have been the most sensitive, the sector with the highest beta over the last 12 months? Personally, I was thinking technology or industrials, but technology is not that aggressive at all. It's not that offensive at all. It's energy, industrial, financials. And on the downside, I always thought that staples was the de facto, well, maybe together with utilities, defensive sector. But you see, it's much closer to the middle. Healthcare, real estate, and utilities are much more defensive than the staples sector. Now, again, we can change that here. If we switch that to 48 months, you will see that this changes. And in Excel, you can actually do all kinds of funny things. You can play with it. And if you say data, and you sort, and you say, oh, that's not good. I need to do this one here. Data, sort, boom. Okay, that doesn't work here. Oh, because I'm on the wrong here. Data, boom. Let me show everything. Sort, see. And you see that these have now changed. So there is quite a bit of maybe subjectivity with it, but with this, I now have a much more, let's say, quantifiable, quantitative way of looking at offensive and defensive sectors. And if we look at the chart here, then this is the traditional ranking that we have on the chart. If I now switch this sequence of sectors based on the beta values that I've found, and I start with the high values here and the low values there, then this is what you get. And I think that's very interesting. It's not extremely different, but it's different enough to pay attention and keep an eye on it. I mean, we still have utilities on the far right-hand side and real estate, but staples dropped a little bit more to the middle. Technology is now much more here. It was all the way to the left. And energy is super offensive. It used to be somewhere in the middle. If you look at energy, was like somewhere here in the middle, right at market end. And also discretionary, which was far away to the left, very offensive. If we move here, discretionary moved over there. So I'm going to keep an eye on that and see how that fills out. But we can actually start, continue to use this when we look at RRGs and try to actually plot these sectors over the economic cycle in this new way and see if they fit the RRG bill better, or maybe I should say more neatly right now. Because when if you read my blogs, then you must have seen that in the past I've tried to actually overlay this sector rotation on that sector rotation model. So the RRG on the sector rotation model. And sometimes I had trouble to fit what I saw on the RRG onto the theoretical model. I mean, putting together that spreadsheet and that sheets was the better part of my day today, and it's 4:45 for me now here in Amsterdam. So I spent quite a bit of time on that. So I haven't had the time to actually do a little bit of study on how that responds, or if that responds differently on the RRG. But my bet is, my gut feeling says that this may actually be a better fit on the RRG and track the rotations. By the way, if you like a little bit more action, you can calculate that beta on weekly or even on daily data if you like. You can just play with it. Anyway, this was what I wanted to share on offensive and defensive sectors. We pretty much have been stuck with an assumption by Wall Street that, you know, a couple of sectors were super aggressive. Like, as I said, I mean, in my mind, technology was the most aggressive sector. It turns out it wasn't. So the lesson that I learned today was that it pays off every now and then to challenge some common assumptions and do the research, maybe do the research again, and check whether those statements still hold up and are valid, or they need a review. And I think this one might actually need a review. We're going to go to a short break right now, and then after that, we'll be back with a couple of questions and what the other things that we want to talk about, like tech fundamental, and maybe we have some time to play around with some RRGs and look at what's happening in the markets right now. We'll be back after a few seconds. All right, and here we are. Y'all have not been typing away very much. There is one. Here comes another one. Rachel, can you feed me the first question?
Yes, I certainly can. This question comes from Russ, and he says, I bought MFC recently. I love the dividend, but looked at the RRG graph, and it seems way overbought.
Whoa, okay, so MFC, let's stick that one in an RRG just on its own. Well, this is a weekly. I mean, first of all, it's good that you stick it in an RRG graph because it gives you a different picture than from all the other charts. However, I don't think you can see something on an RRG as overbought, or maybe you mean, let's bring up the chart itself. Maybe you're referring to like an RSI or something like that. Here is MFC, and I'm just gonna add. If you talk about overbought, oversold, I'm just gonna assume that you're looking at the RSI, and I'm gonna plot that above the chart so you can actually see it. All right. So on this weekly, I don't see anything overbought. As a matter of fact, I see a range in relative strength versus SPY, and I see RRG lines that are picking up, especially if this horizontal resistance here in MFC can be taken out, and the catalyst will very likely be taking out these highs. I think this one could be in for a further rally to this previous high. And I think Russ said that he love the dividend. Okay, so this is the one that we may want to have a look at on absolute basis. So I'm going to change that to underscore MFC. Let's see how this chart looks. No, well, all right, it's not mega different. Relative strength still the same. This high is now a little bit better pronounced. That's what I mean with unadjusted. This is where the real resistance is. So that's like 19 bucks. If we go above 19 bucks, that looks really nice. And I don't think the weekly is overbought. Okay, so just to make sure, I think that the daily, no. Sorry, Russ, this one is not overbought. I mean, this is very strong. I mean, mind you that an RSI that is rising is a good sign. And you got to be careful with labeling overbought as something negative. The biggest rallies take place when a stock is overbought. We don't have to look far. Look at this here. Here's the, when it rises, you got this big rally, and here it pushes and it pushes and it pushes. Only when it comes out of that overbought zone, that's when you need to, well, maybe start to worry or pay attention. And when you have divergences starting to pay up. Those are the two things. When I look at an RSI, those are the two things that I pay attention to. Divergences and getting out of an overbought zone or getting out of a oversold zone. And that's what we see here. Here we saw some divergence. We saw some divergence here as well. And here you get out of the overbought or you get out of the oversold. That's where you may start to pay attention. From a relative point of view, well, I mean, this is weakening a little bit, but I don't see any issues with that. It's actually a pretty good looking stock. Thanks for that, Russ. We don't have any other questions. Fascinating work on beta timeframes. Yes, thank you, Dan. This was a hunch I got this morning, actually. We have just moved to another property, and we live on an old horse farm, believe it or not. We came right out of the middle of the city, and now we live in the land. And when I walk out of the door, I'm in the middle of the meadows. And in the morning, when I feed the horses, you can actually do a lot of thinking. It's crazy. I mean, this stuff clears your head. And I was thinking about all these assumptions and stuff, and offensive and defensive is one of them. And that's I'm guilty of that myself. I talk about offensive and defensive all the time. I mean, it's just in your blood. It's in your DNA when you work with sectors. You always have stuff about offensive and defensive. And then I thought, is that really true? And I remembered the work that I did last year with Sam Stovall on that sector rotation model, trying to pretty much, put it back in the box and make it behave. And it didn't want to do that. And so I thought, hey, there's beta. Let's play around with that and work on it. And when you start to work on a spreadsheet like that, well, maybe you've been there and done that. But when I start to work on a spreadsheet like that, you start with a couple of cells and a couple of rows of data, and before you know it, you're a couple of hours further down the road, and you got stuff like this. So there you go. Thanks for that.
Open it. Julius?
Yes.
We have another question from Dan S. And his question is NRZ, Mortgage REIT. What's your take?
Well, mortgages and REITs are very high dividend paying stocks. So for the RRG, I like to use the normal, so the adjusted series that includes the dividend. That's the one that you see here. And we're going to look at this one here. And okay, now I'm going to duplicate this one here. So I want to see NRZ. Yeah, that's completely different. There you go. So here's your dividend payment, and this is with high dividend paying stocks, you got to be careful. It's picking up. That's good. It's still relatively low on the RS ratio scale. Where are we here? Is this good? Yeah, here we go. This is the weekly. Oh, this is a daily. That's why it doesn't fit. So update here. It's improving. That's what we see here. But the RS ratio is still relatively low. And you see that this still qualifies as a downtrend. Although you may, when you start to draw some trend lines, you may be able to see some breaks, some cracks. But the biggest problem is here with price. It looks as if this is breaking out and is pushing against that resistance. As I said, and I wrote in a previous blog, with high dividend paying stocks like REITs, you got to be careful because they distort your image. And this is, I think, and you see immediately that this is a very clear-cut resistance level, 1580. That is where I think the resistance should be marked, because this is the prices. These are the prices that people have in their minds. These levels here. These people have not traded at 1530. They have traded at 1580, 1575, 1580. So I think this is where you should watch for resistance. And if I draw some trend lines here, that is still under pressure. The RS line is still under pressure. So I'd be careful with this one, especially from a trend point of view and also from a relative point of view. But I can understand that you like the dividends from this one. So yeah, and it is a low beta, as we've just seen. It's the lowest beta group around. So if you're defensive, then this should be fine. It should be no problem at all. Rach, I think I'm going to go forward with one. It's not actually a question. It's more a remark that I got from someone, and it has to do with a piece that I did not too long ago on asset allocation. And I marked the asset allocation, that out, because we're talking about LQD. That's an ETF that tracks investment-grade corporate bonds. Now, this might be a little bit technical, but these are bonds issued by corporations, and investment grade is a qualification of the quality of the debt. And then you got like high yield, which is much higher risk, and obviously government bonds are the least risk. And these are the only three that I've got on this asset allocation chart. But there's a whole myriad of maturities and different gradations. But the point that the person that wrote in, Sheldon, made, and I think he's right, is that we at StockCharts sometimes come bewitched by technicals while ignoring fundamentals. Now, I'd like to make that a little bit more subtle. Speaking for myself, I've always learned in all my years in the industry to not ignore fundamentals. They are way too important to ignore. Okay, my job, my style, my work, my life has all been around technicals and quant, but I do know that fundamentals are around, and I do pay attention, and I do respect them. And what Sheldon was pointing out was a piece by Morgan Stanley, who observed that fully 50% of the investment-grade corporate bond market is now rated just a single rung above junk. Even in a mild recession, the weakness we presently observe in junk debt could spread far more quickly than investors might imagine, even among so-called investment-grade bond funds. So this is something that Morgan Stanley observes in the corporate bond market. And I think that, assuming that they're right, and I trust Morgan Stanley to have done their homework. So this means that the lower part of the corporate bond market is weakening. So there have been a lot of downgrades in these corporate bonds, and which is a warning signal. And this is where I think fundamentals can play a very valuable part and give us a lot of information ahead of time. So thank you, Sheldon, for pointing that out. The only thing is that with LQD, that's the top of the market, so that's not visible yet. But he's right. We need to be aware of the fact that this might affect corporate bonds. But from a technical point of view, so far, that corporate bond market is still the most attractive, but with a warning signal, a caveat that there is something cooking under the hood of that market. So please keep all these questions and suggestions coming in, because I do read them and I pay attention, and I'll talk about them in the show when it happens. This was the third episode of Sector Spotlight. Thanks for watching. Please keep those questions and suggestions coming so we can make sure you and I are on the same page. I hope to see you back next week, same day, same time, every Tuesday, 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you'll receive a nudge every time a new article is posted.